US dollar selling stops in the latest week, but higher time frame remains bearish with key non-farm payrolls due out this week. How is the dollar going to react, guys? Ken Chigbo back with another E8's market fundamental update. Let's jump straight into this. Guys, we're back with another week in these beautiful markets. Now, starting off with the dollar, it did actually manage to just about close in the green in the latest week after that heavy selling pressure that we saw the week prior. Now, the higher time frame analysis, which we're going to look at in a moment, remains bearish. Okay, when we look at the monthly, there are a number of macro support factors for continued dollar downside when we've got the cloud that still sits over the United States head with the US and China talks, which I want to touch upon in a moment. Still, we're only in this pause period, right, where tariffs have been effectively paused until August. We've got the uncertainty still with general trade talks outside of China as well, with US and EU. We have that rising debt fears in the United States, where debt's expected to surpass $36 trillion with Trump's new latest tax bill, which expects to add on between $3 and $4 trillion worth of debt. And then we've also got the general slowdown. We are seeing a bit of a slowdown in the United States with data. Consumers are less confident. Spending is coming down. We've still got this high interest rate environment. Bear in mind as well, rates are being kept higher to try and bring down sticky inflation. And we've obviously, as I said, over these past videos, we've gone over how we've had a capital flight out of the United States and into other economies, such as in the Eurozone and in Asia as well. Now, obviously, all focus on non-farm payrolls, which we're going to get into in a moment. But I just wanted to get your attention on this and just show you. Remember how I said that talks are fragile, and we're probably going to expect trade talks for the whole of 2025. But look here, out of Treasury Secretary Bessent, he said US and Chinese talks a bit stalled and need Trump and President Xi, to weigh in. Okay, so it's not really encouraging, is it? And it just shows how not easy these talks are going to be. And I knew that, and I said that to you guys. Based on historics, these talks are going to be tough, and anything can happen still between now and August. It's a long time where things could just fall through and turn south, and we've seen it before. So just be aware of that. So that's a vulnerability for the dollar. Now, when we look at the dollar, as I say, in the latest week, we paused this selling for the time being, but structurally, we're still bearish, as we've been going over these past videos. We've been printing lower highs and lower lows. Structure is still very much intact. We've still effectively, most recently, printed a new lower high here. Got a big retest around this psychological 100 mark, 101, where rejections can still be seen, and we continue to the south. Now, obviously, this is very much going to be dependent on data this week. If I just filter this out and just focus on dollar, obviously it's labor market data. Okay, ahead of labor market data, we do have PMIs as well. ISM manufacturing PMI, which has been slowing down a little bit, as you can see here. Generally speaking, when I say slowing down, we're below that key 50 mark. Remember, when we're below 50, that's contraction territory. That means manufacturing sector there via the ISM is contracting, which is obviously not a good place to be. It's not growth at the end of the day. We've got Powell speaking. Okay, so we're listening out for any potential comments on the economy and monetary policy from him, latest insight. We've got JOLTS job openings, which are on a trend to the downside. We know the labor market's slowing down. Look, less job openings there, as you can see. Previous numbers even revised lower. Okay, then we've got ADP, which is the privately conducted payrolls number. It's not really a massive correlation there. It's not the government's official figure. This is a privately conducted figure, but all eyes. Then we have services as well. Let's not miss that. Services PMI is above 50 right now, so it's still growth, and services is a big part of the US economy. But all eyes on this non-farm payrolls number. Now, one thing for me is obviously people get sucked into the headline, right? Where we've seen better than expected numbers. But then when you look at these previous readings, we've consistently been coming down. We've been slowing down. Those numbers have been revised lower, which isn't good. And then general trend is to the downside. Remember, we were as high as producing strong 300K numbers, 200K, and now you can see it's just sort of gradually averaging to the downside. We're definitely seeing a slowdown in the labor market, as highlighted by the Federal Reserve at their most recent rate decision. Okay, unemployment rate expected to remain at an elevated 4.2%. When I say elevated, it has been picking up, as you can see, gradual unemployment rates picking up. Average earnings was lower last month at 0.2%, which is disinflationary, right? If we've got people getting paid less, it means that we've got less money being spent potentially. So For me, I would like to see this continuation of a trend to the downside. As you can see here, markets are expecting a lower non-farm payrolls number. I would like to see the labor market continuing to cool. I can't really see the upside scenario at present, but obviously anything can happen, right? When we look here at the dollar, as I say, vulnerabilities, there may be room for another pop to the upside before continued selling, but I still want to see these lows being taken out of April down at this 98 area and just falling in line, as I continue to say, without sound like a broken record, but continue to respect the structure. Nothing has changed yet massively positive for the United States to see those flows and that encouragement for investors to fly back into the dollar. Okay, so I would like to see a continuation of selling this week. Now, just obviously, let's just take a look at euro quickly because the flip side of Dixie, euro makes up over 50% weighting of the Dixie. There's still some potential upside pressure here where we had that wick, flip side to the Dixie, that wick of April that needs to be filled. We're going to get into euro in a moment because we do have the ECB rate decision. But vulnerabilities, I believe, are still here for the dollar, just based on this clear breakout of this bearish range at around that 100 mark there. Look, you see where along that dotted line, can you see where that monthly support was? And it was obviously taken out in April, and we still remain below in May. So I still see it as vulnerable for this month. The euro. We do have the ECB rate decision where these guys, again, are expected to cut rates down to 2.15% from 2.4%. So a 25 basis point cut. They've been doing this gradually. Now, people always ask me, Ken, why is the euro not weakening when these guys are cutting rates? It's because the good thing is with the ECB, what they're what I'd say a strong point of theirs is they communicate very well to the markets. Now, remember, I've said this on previous videos where markets are built up on expectations. Key part of when you're trading economic calendars is trading outside of what the markets expect, outside of what they've priced in. So the ECB has always been quite strong in their communication, their guidance in terms of, look, markets, we're going to be cutting rates again. So this won't be a surprise. So we won't see the effect that it should see in terms of euro weakness because it's already priced in. And the euro, as I said, we've seen a lot of stability in the euro. When you look at the previous week? The week before last, we had decent PMIs. They remain steady here. Previous numbers revised high there, which is good. We had the economic survey from ZEW. When you look here, it's not on this, it'd be orange, second tier data. Look here. Bear with me one moment. Okay, there. German ZEW data 25.2, which is encouraging. Okay, so this is conducted by ZEW in Germany Economic Forum, where they see economic sentiment is bullish. Okay, it's picking up there. And I'm not surprised because remember, we've had that cash coming in. We had that 550 billion euro stimulus package being approved. The IFO business in climate still solid 87.5. So it's encouraging signs with the euro. And as I say, they're just managing market expectations, cutting rates as expected. So there's no surprises there. So with euro, I don't expect a doom. The only way euro sells this week is if we get a doom and gloom outlook from Lagarde, and I don't think we will. Things are remaining consistent. Things are remaining generally steady in the eurozone. We're not sort of expect to see many downside risks as such in the very near term, as long as these trade talks don't turn south between Trump and obviously the EU. Now, obviously, flip side to the Dixie. Upside pressure is still eyed for me. I'd like to see these highs of April being taken out. Structure for the euro has been very clean. You know, when you look at this ascent that we've had since February with these higher highs and higher lows. Okay, we've had this sort of period of consolidation. We had this pullback. We broke out of structure last week, something I sort of personally capitalized on. We had this breakout of structure here, big bullish move to the upside, and obviously again a bit of a pullback because there is a lot of supply. Yeah, I did mention in the previous video how things could get a little bit choppy. You see here between 113 up to 114, there's a lot of noise, a lot of congestion in a way. Okay, but I would be liking to see dips continue to be bought outside of this consolidation. Really to confirm serious longs, in my opinion, I want to see 114 getting ground down, a breakout and retest of this zone here. And I believe it'll open up the door for a quick return in towards 116 and go and print a new higher high as part of this structure that you can see here. So I'm still in line and remain with the view of seeing some buying pressure for euro. The Canadian dollar. We do have the Bank of Canada rate decision where it's very much split actually, guys, in terms of what the Bank of Canada are going to do as to whether, as you see here on Forex Factory, the It's leaning towards expectation of a cut of 25 basis points. But from a lot of what I'm reading, it's very split. There's quite a few key analysts and institutions that are expecting unchanged. And the reason for that, when you look here, we had GDP for Canada came in at 0.1%. So it came out of that contraction that we had on that previous monthly reading of minus 0.2%. Inflation in Canada remains sticky, as you can see here. Now, if we've got sticky inflation, we don't want to rush to keep cutting rates, because if we keep cutting rates, it only potentially creates the risk of more inflation, because if we're lowering people's costs and their debts, their mortgages, their loans, their credit card balances, all of that, freeing up cash for people, lowering costs, people are going to go out and potentially spend more. And then obviously then we've got another issue of prices going up again. So it's a split one really, guys. It could go either way. So expect some fireworks for Canadian dollar decision. Now I'm going to give you a couple of scenarios. If, for example, the Bank of Canada do cut, because it's not fully priced in, we're going to see CAD weakness. But then if they do cut, I believe they're going to have the outlook of, look, we're going to cut, but we're going to be on pause for a while. So don't expect us to cut again for a while. So then CAD would weaken initially on the cut, and then it would reverse that weakened move, that downside move on them, on their outlook, on their rhetoric, on what they're saying. Okay. If they keep unchanged, okay, and they don't cut rates, CAD will strengthen initially, but then I expect the outlook would most likely be dovish, be like, look, the Canadian economy is downbeat at the moment. It's still uncertain. We've still got the risks of tariffs. We've still got the risk of economic slowdown. Canadian economy is still not performing as it should be. So I think if they hold and CAD strengthens, then their outlook should be dovish, and then CAD weakens. Okay, so there's your couple of scenarios there, guys. I'm kind of on the fence. I'd lean towards them. It's a tricky one. I'm just going to digest what happens and then trade what I see. Now, when we look at dollar CAD here, I'm not, as I've said to you guys in previous videos, I'm not a dollar bull and I'm not a CAD bull. Okay, for obvious reasons. But dollar CAD, as I said to you before, is likely to get sucked back into this range, and you can see we're grinding back into this range. When I say this range, look, you can see it here. Range to the upside at around 139, range to the downside around 132. Sort of 700 pip range there, which we're going to get caught in, and probably for a little while until we get a major catalyst. I would lean towards potential continuation because structure is still quite intact there. I'd lean towards a continuation to the downside with the underperformance in the dollar. So just keep an eye on the potential that we're grinding down this sort of 3750 area, get a retest, rejections there, and just work our way zone to zone and fall back within this mundane range, as you can see here to the left. So those are my scenarios. Keep locked in on that because there are some fireworks and volatility. We're also going to keep in the labor market data, which has been worsening in Canada. It's one of the reasons why I'm bearish on CAD, because we're seeing a rising in the unemployment. We're seeing worsening in the employment change, generally speaking. Less jobs being added, unemployment going up. So I do generally speaking remain a CAD bear, but this is going to create volatility either way. So stay locked in on the Bank Canada rate decision. Outside of those key events, then keep an eye on Swiss CPI, BOJ Governor Ueda. That's key as well because markets are expecting continued action from the BOJ to carry on hiking rates. Because when you look, just bring this up here, inflation has been rising in Japan. Just want to bring this up here so you can see Tokyo core CPI you saw last week elevated at 3.6%. We had the national CPI reading as well, which is yellow folder. National CPI for Japan, look, BOJ core CPI elevated at 2.4%. Tokyo, as I've mentioned, the week before, as I say here, national core CPI elevated at 3.5%. So we're getting closer towards BOJ rate hikes. Obviously, they've been cautious because of the tariffs, but all eyes on Ueda to provide some further guidance, and that could help with those flows back into JPY. When you look at some of the yen pairs, I am bearish, obviously, on dollar yen, given the obvious with my bearishness of the dollar. Structure's been very much intact to the downside most recently with these lower highs, lower lows, and I'd like to see a continuation. I'm really interested in some shorts with dollar yen once we break down this very key support around sort of, I'll give you the range of 140, 150, down towards sort of 140 on nose, that 150 pip range, breakout retest there, will open up the floodgates in my opinion. So once again, a week filled with volatility. Have an amazing and blessed week, and I'll catch you on the next video.